Hey, Full Throttle Traders, Jeff coming back to you here. I want to take a few minutes today and kind of outline where we are in the markets. Remember, some very crucial numbers coming out tomorrow in terms of CPI. Now, this is the first CPI numbers that's come out since the inauguration of the new administration. So obviously, they're not expecting miracles. Things don't happen. Things are usually lagging in that. But nonetheless, it is the first one. And for that reason, the last couple of days, things have been trading very kind of specific. Not a lot of range. There's a couple reasons why. Number one, we are on the fringe of that CPI. Traders typically kind of trim positions. They kind of sit back. They don't put a lot of new money in specifically until they kind of know maybe where the bigger context of the market's going, or at least the stocks in general. And number two, the VIX. And I'm going to share some couple things with you that will help you kind of define when you're looking at the VIX and trying to determine the market distant, what they expect, the market expected move are. You can look at obviously at the standard deviations on a 1 day, maybe 1 week or 1 month. But if you want to get a little more specific, look at the VIX. So I'll take a few minutes and kind of share that with you here. Stay tuned for 1 second. We'll get going. All right, so let's take a second and look at where we are in the markets in general. This is the SPY. Obviously, this is the broader market. This is where a lot of most people hang out when it comes to looking at the market in general, because it is the bigger portion of the roll. You can see we've double topped here, kind of triple top in a way here. If I draw the trend lines back, we're a couple of things here. The 20-period moving average, which is actually this faint line. I'll make that a little bit thicker here for a second. That's the mid part of the Bollinger Band. So if I put the Bollinger Bands up here and plot that, you can see we're just above the midpoint. So we're at the high end here, but we are at the below the midpoint in the trend line. Now, ideally, I want to look at two things when I'm trading. I want to see where the market is in relation to the midpoint of the Bollinger Bands. This is simply a default standard deviation setting of 2 with a 20 shading 0. I've just got about a 20% shading on it. But you can see here we're at the upper level of the Bollinger Bands, and each time that we've gapped down, we have been bought back. Now, I'm a little surprised that at least the second time down, we broke this line. We actually gapped below this. This is off that tariff news, and we did not at least come back down to at least question this trend line. We got bought back twice. That's a sign of an extremely bullish but cautious market in where we are. You look at the trend line, though, and I take the Bollinger Band plot off. You can see here, I'm going to lower this on the 20 as well. I do like to kind of have it shaded in there because I do use the 21. I don't like to have too much things on my chart, but there are certain things that are important. You can see how we're holding in a very choppy, whippy base. Now, when we are in a wide and whippy order like this, which we've been running from 380 in the SPY for the last few years, this typically denotes potentially a stage 3. Well, a stage 4 always follows a stage 3. A stage 3 is basically after trend 2, stage 2, market goes into consolidation. When it's wide and whippy, that tells you that you are on the cusp of potentially going into a stage 4 or a market drop or a pullback of sorts. This year's a little different because a lot of things have converged with the new presidency, a lot of situations that's been kind of media focused or specific individual focus that's changed this year over a lot of years. So maybe this stage 3 actually, or it looks like it's stage 3, is a wider area that pauses and refreshes and goes higher. It's possible. But normally I would see this after a strong bullish run as a tune to start going lower, but breaking under the 575, 570 area, that would kind of get us into that stage 4. But that's to be determined. It hasn't happened yet. Look at where we are here. Very bullish type trend line that we've touched the SPY. As of the close here on 2/11, February 11th, we closed last part of the day, a nice little rally up into here. We closed above the 8-period moving average. Let's take a look at the Qs for a second. Now, the Qs a little bit longer dated back here, very similar, obviously. We've been up against that trend line a little bit more. Now, the NASDAQ is representation that, the top 100, most of those being the tech-filled markets. You can tech has been a little bit stronger. Once again, I'll go back and give you a comparison to the SPY. You see the difference in there? Not by a great degree, but enough, right? The third one I look at is the diamonds, where we are in the diamonds here. I don't actually have a trend line. We basically just double topped here. We are very bullish in the diamonds. We haven't pulled back that much in the Dow stocks. Again, a lot is related now to these earnings that are coming out, with a lot of tech earnings. Today you had SMCI, NVIDIA later in the month, and a few others as well. So this is just more of a less of a pullback, less of a bearish stance in the sense of the way it's dropped and then got back in here. The diamonds or the Dow has held up pretty good. Yes, it had the drop, but this is just more of a whiplash back and forth straddling the 8 EMA. And then finally, the weaker part, the Russell, you can see as I draw the trend line here, much weaker. It's been stronger than normal, but much weaker than normal. I draw the trend line even into here from that top. You can see how we're well below these tops in here. We double top here in the last part of December. So weaker yet, and just kind of staying to the low outside of the trend line here that we developed throughout last part of last year. Now, the interesting part about the markets, and I've been telling our room members, in light of CPI coming out, it's better to lay low just for a day or two. Let the market settle, let it cushion, because what you're noticing right now, if you have been trading, follow through is not very aggressive. It's a lot of head fakes, not committal money, and the volume today set around the SPY for 2 hours. It did not go pierce. It was between 12 and 14 million in the SPY between 12 and 2 o'clock. Now, I know that's the Dolgens, but typically we're about 18 to 22 million at that time frame. We were about not quite half, but just about 40% less in volume. So what does that mean? Why is volume important? If you find your stock and you find a pattern, the odds are follow through is going to follow volume. People that are jumping in and pushing those stocks in that favored direction. When you see subdued volume, they could still go, and certain stocks still will go, but usually you're looking at them in the rear at a little bit more of a latency of like what you missed or what could have went. They're fewer and far between, but patterns you may find, the odds become down. It's almost like card counting. Not that I am a card counter and I don't condone that, but the reality is if the deck is not rich, if the odds are not stacked in your favor, and you're playing the same method as a card counter, you're still going to have your wins. You're still going to go up, but the odds are over a longer play, you're going to actually begin to slope downward because you don't have a rich deck. Much like that, we don't have a rich deck in the market when we don't have a lower volume. They're very specific. You need to go in and out on certain plays, maybe stay a little more scalpy, not so much committed to the longer term play, if you will. Now, finally, I want to take a look at the VIX here and kind of show you what's happened in here. Going back to the yen carry trade right in here, if you look at the next one here, this is the not the tariff move was over in here, but basically another big shot down of the market here. What day was that? On the 18th of December here. And if you look right now, because we're around the 30th trading day of the market here, we're actually beginning to shed some of this here. Now, when you're looking at the VIX, what you're noticing is that the follow through in the market, the $7, $8 moves in the SPY, even though we were around 16 VIX 2 weeks ago, 1 week ago, maybe 5 to 7 days ago, we were still running $5 to $10 a day in the SPY with the same VIX. Well, what's happening now, VIX is a 30-day look back. So we're looking back 30 days. You're beginning to drop these candles off there. So now we're at a true 16 VIX, and you're going to see $2.50 to $4, maybe 5 some days, but not the 10 days. Again, why is that the case? Because of the look back. If you look at rate of change today, even in the SPY, there were moments where the SPY had 15 cents of range back in here. Look at that bar there. You had probably 11 cents of range. Then you had a bigger bar later here. That's a 2-minute chart. Here's a 5-minute chart. You had 14 cents of range in there. Then because you had 30 cents and 40 cents of range. So when you're seeing these VIX at 16 and $8 moves, when you had that big carryover VIX from the last 30 days, you're seeing $1.50 5-minute candles. But once that bar dropped off, we're beginning to kind of stabilize and not seeing these one-offs, because this does play into the current VIX pricing until it is eliminated. 30 days back, every 30 days it keeps dropping a candle, and now you're closing in on a more precise VIX. So that might be why you've seen why is the market going so long or so wide in 5-minute candles or even the daily candles in the SPY when it's normally running $4 to $5, it's running $7 to $10. It's because of this. So kind of know your VIX, and as you begin to drop off, things begin to tighten up. Why is that important? Because if you're playing credit spread specifically, when things tighten up, what happens is you are able to play the longer market with a shorter run, but when that changes, the market gets closer to you. You can't hide anywhere, so to speak. So you start getting in these tighter places, then you have a wide range bar that takes you out in that. So again, that's a product of how the VIX is working. We're getting back to some normalcy in here. If you look at the last couple of days here, pretty inside, just kind of shoving itself around between the 8, the 21, and the 50 period moving average on the daily chart, and likewise on the 65-minute. You can see the SPY here inside day, and for a decent part of the early part of the day, we had an inside day of an inside day. But ultimately, 2 inside days from this big pullback day on Friday. I think the market is just setting up for some news tomorrow. We're going to see how that does. I would just stay, drop your share size down, scalp randomly, take shorter targets for the next couple of days until the market settles out. And keep in mind, you also have a holiday coming up on Monday and President's Day. So typically they'll make their moves. They'll settle back coming into Friday in front of a long weekend. Just more things can go wrong. They typically like to stay out on a long weekend, or at least a good portion of that big money, that follow through money, will stay out. So anyway, I hope this was helpful. Be sure to click the subscribe link. You'll get these updates from me every few days, as well as specific trades I'm going into of how we're doing in our room. We have a lot of members in our room, and we actually kind of coordinate with them on when we are laying back. The last couple of days, we've been sitting back. We talk to them live throughout our trading channel, and you're able to see some of the plays that we actually call on here. So be sure to click the subscribe link, join us, learn from those specific trades that we've taken and how it can better and help your trade in the future. Thank you. Until next time, remember, Full Throttle Traders, we trade what we see, not what we think.